Hey everyone, welcome back to the MHP Show podcast. I have another fantastic guest with us today. And this guy probably doesn't need much of an introduction. I have Mr. Kevin Bupp here with Sunrise Capital Investors. He's the founder of that. He is also the host of Real Estate Investing for Cash Flow, which, I mean, it's got to be one of the number one real estate podcasts out there. Is that correct?
I think it used to be. I don't know how far. There's so many more podcasts now, but it's been going on for 11 years now, so it's been out there for quite some time. It gets lots of downloads, but I'm not sure if it's number
Yeah.
one. I think it's number one. I think it's the number one, commercial real estate podcast, but not sure what iTunes thinks.
Yeah, got it. Well, it's a great podcast if you haven't checked it out. But welcome to the show, Kevin Bupp.
Yeah, Derek, thanks for having me, bud. Excited to be here today.
Yeah, absolutely, man. I'm glad to have you. And it's interesting the other little picture you have behind you there, the mobile home park investing podcast.
Yeah.
So I will have to say that was a podcast that was some of the catalysts of Kevin selling me on how great this asset class was. And so I think you've probably heard that before, but I know you've definitely, probably been one of the main people to make this asset class as popular as it is.
Yeah. No, that's
Um,
funny you say that. My business partner sometimes gives me crap about starting that show. He's like, I think we wouldn't have had as much competition if you wouldn't have started that podcast however many years ago. So, but no, it's been a great industry, man. It's great to see new faces because when I started, it was just a bunch of the old timers are good, but like it was very behind the times, and so it's always good to see new faces, new blood, and just some evolution happening in the within the industry.
yeah, totally. I mean, it's definitely changing, and I know since you've got in, it's changed tremendously.
Yep.
So, Kevin, I got to ask you, you've done a ton of podcast interviews. I'm sure you have. I don't know how many, but I'm sure it's a lot. So I've got to ask, like, what's a question that you wish someone would have asked you, but they never do?
Hmm. Yeah, that's a great question. I don't know if it's never, if it hasn't been asked, but I think just the why, like the why. Why are you doing what you're doing? You're great. You might be great at what you do, whatever the focus is, specialty, this, that, and the other. But like, why? Aside from money, aside from all those other things, why? Right? Like, what really drives you, and what? Because I get excited to get up and do deals in the morning. It's like you do. We were talking about a deal before we hopped on here, right? You're talking about with a seller, and I love that. Actually, I love that side of the business. That's really, what gets me excited every day is the art of the deal, right? Trying to
Yeah.
negotiate something and find opportunities that are going to help us continue growing the organization. But that's part of it. But that's not really the root reason behind it all. So I think that's probably the one question is like the why. Like why are you doing this? Why do you do this? That I think it gets asked sometimes, but not often. I don't think we ever get really to the root reasons of why people, whether it's me, you, or anyone else that's listening here, like why are you doing what you do? Like why are you going down this path?
Yeah, for sure. And so what is that for you?
Yeah, yeah. I mean, for me, it's family. I mean, I got into entrepreneurship at a really, really young age, and at a young age, it was about material things, right? It was about having to at a really young age having the coolest BMX bike, right? My parents, I grew up very blue collar. Weren't poor, weren't rich, we're somewhere in the middle. But Christmas and birthday are like the two times of the year where we could expect to get something, right? And that was basically outside of that. It was deal with what you have, right? Whether it be a bike, sporting equipment, what have you. And so I just learned at an early age to make my own money. And again, back then the why was, why do I want to mow lawns or shovel snow or deliver newspapers? It was because I wanted to buy stuff, right? I wanted the things that
Mm.
I didn't want to have to wait for Christmas for, baseball cards, sports cards, all that kind of stuff, right? I wanted to buy stuff. As I got older, I think that's really changed. It's really changed in the last, probably 12 or 13 years. For me, it's really based on my family, and it's not just necessarily providing for them, because there's many other things I could do to provide for them. But I think just being an entrepreneur, it just happens to be that it's in real estate, right? But like being an entrepreneur for me is being able to buy back time, building an
Mm.
organization that that is that's sustainable, that can stand the test of time, that can continue doing good, doing better, serving our residents, serving our employees when I step away for weeks at a time, right? And those weeks at a time are the time that I get to additionally spend with my family, with my boys and my wife, just creating memories like that's for
Mm.
me, like that's it, like creating more memories. Like if I'm very good with handling stress. It drives my wife crazy. It just takes a lot to get me upset. um I don't think I'm very rarely ever say I have anxiety or anything like that. The one thing that gives me anxiety though is how fast my boys are growing up. They're 8 and
Mm.
11, and I cherish every moment that I get to spend with them, like real quality time. You know what I mean?
Sure.
It's really difficult when if you're working the daily grind and they're going to school, sports, all this kind of stuff. But again, for me, building this company, doing what I do is to continually buy back more time in my day,
Mm.
in my week, in my month, in my year so that I can spend it with them.
Yeah, and that's powerful because I think, every entrepreneur when they like transition, whether they were doing a 9 to 5 first or whatever, they're like, man, I don't have any time when I'm working this job from 9 to 5 or 9 to 6 every day. But then they become an entrepreneur and they're like, man, to get
You're
this
working
thing going,
you're working
you
twice as much, yeah.
I got to do
Yeah.
twice as much, right? And I remember for me when I was still in the insurance business trying to build the real estate business, I mean, I was staying up till 2, like having still getting up to go to the gym at 5, like yeah, I was working. It was insane. But I was doing that for the same reason because I wanted more time with my family because we were having a kid at the time.
Mhm.
And honestly, I think that's why most entrepreneurs, quit and give up because they're like, damn, this is actually more time than I was doing before. So I love that. I love that. Um, so I want to ask you this because you've also been in business for, quite a long time. Like, how long you been in the real estate business?
I bought my first property at the age of 20 and have been doing it ever since. I think there was really only 3 years where I didn't buy anything, and that was 2008, 2009, and 2010.
Yeah.
Those 3 years, and that was basically running damage control on what happened during the Great Recession and just dealing with that crisis. But from the age of 20 all the way to today, I don't think there's ever been a year, with the exception of those 3 years, where real estate wasn't the core focus, where I wasn't actively buying real estate of some sort. It started as single family because that's what my mentor that got me into the space. That's what he did, and so I'm not a big fan of reinventing wheels. I like trying to figure out a more efficient way to do things. But like as far as like a core business strategy, if I see something that's working and it's working incredibly well, I don't try to reinvent that wheel and fix things that aren't broken. And so that's kind of how I started, just because my mentor, that's what he did, and I saw a lot of success that he had over the 2+ decades he had been in it. And so my early to mid 20s, I built up quite a big portfolio of 124 single family homes to be exact,
Oh, wow.
and then a few hundred multifamily doors. That wasn't an active part of my business. That was mostly that I was putting money with another partner. But the active part of my business was single family. That was kind of my bread and butter. That's what I did. And then started really opening my eyes up to commercial real estate. This is before the crash happened. Started looking at different types of commercial investments. Just trying to find the biggest challenge I found back then. I wasn't married, didn't have kids or anything like that, but like buying properties one by one by one, a $80,000 home, a $60,000 home, 120,000. I mean, like it's a lot, and I was having fun doing it, but like that's all I did. I was like, man, this is a lot of work. I'm trying to see the big picture here, like get to a scale to where like I can truly build a team underneath me. And the only way that you can ever afford a team underneath you is if you have enough revenue coming in. It's very difficult. I mean, I was at that point where I had a team, but it was still like that's not a lot. Like you can't have a substantive team underneath you with 120 properties, single family properties. It's like having 120 multifamily doors, right? To think that you're going to have a big organization that you could step away for months at a time, it's just not going to happen, right? And so for
No.
me, commercial, I was trying to open my eyes up, like how can I do bigger deals so that I can, build a larger infrastructure underneath me so that I can create a company that is a little more self-sustainable, that can, continue to operate and have people on the team, good, the right people on the bus, the smarter people than me, that can do better than what I'm doing, trying to man this, not solo, but just being the main, the CEO, the COO, the CFO, kind of wearing all those hats. So that's what really opened my eyes up to commercial in a big way, and then ultimately it morphed by accident into mobile home parks in 2011. Like I accidentally got turned on to this asset class. I wasn't looking for it. Honestly, I lost mostly everything in '08. was trying to figure out what phase two was going to look like for me to rebuild. I knew it wasn't going to be single family again. I really had every intent to just say multifamily is going to be it. Like I can get scale there, understand residential real estate. Like it just makes sense to me. Everyone needs a roof over their head, right? It's one of our basic human needs, and so like that was simple to me. Commercial real estate had some variability, right? You got in 11 and 12, like the market still was in the tank. And so retailers were still going out of business left and right. Like that was
Mm.
tough to really understand. Office has a lot of complexities to it, right? But residential multifamily, just straightforward and easy, at least in my mind. Like I understood it and I was comfortable with it. And so that was the plan. But that plan took a slight shift when I met a guy by the name of Randy that happened to be a banker. And I was meeting with a new guy I was just trying to expand my network. I was meeting with Randy just to meet someone new, right? And had lunch with him. And during that lunch, he had recently retired from being a commercial lender for like 30 years and bought 3 mobile home parks here in Florida as part of his retirement because he was on the other side of the table over the last 10 years of his banking career with a number of clients that had mobile home parks, and he saw how profitable they were. And so during that lunch meeting, which I had no intent or no agenda of it taking place, is that he sold me on how great mobile home parks were, and that's where they came into the fray. I was so excited when I left that lunch with him. I was like, I'm going to go buy one of these things. This is 2011. And hopped on LoopNet, that was really it at that point in time. As far as like, listing sites, there weren't really any, there were a couple of brokers that specialized in the space, not like today. And,
Yeah.
bought that first park, bought it up in Atlanta. And that's where the story began, at least the second part of the story.
Yeah. So how long after you found out? How long after that meeting did you close on the first
It took
park?
me about a year, and most of it was due. There wasn't a lot of good education back then. I mean, Frank and Dave had their boot camp. I'd attended that. I bought their home, the study course. It was on CDs back then. Bought that, but really outside of that, there was nothing. There was no information in the marketplace, and so it took me a year. I had a number of deals under contract, a couple that I literally I killed, and I regret ever killing because I know who bought them after the fact. And they did incredibly well, but it was very difficult for me to get a grasp on the business model, and there weren't enough people that I had in my circle that had been in the business. Aside from, I met a lot of mom and pops, but as you and I know, like they're not the most efficient at running, and then pretty much most of them had gripes about the business. They complained about the tenants, they complained about the homes, they complained about this and the other, but they didn't have good systems and processes in place. So I was getting bad advice from a lot of people, and it gave me cold feet on a number of occasions. And I
Mm.
finally just pulled the trigger. I was like, I pulled the trigger on the first property. I was buying it so cheap. It was fully vacant, all park-owned homes, fully vacant. I mean, it was about the hardest turnaround you could ever imagine. But I was buying it so cheap that in my mind, I was like, if this plan fails, I know that each one of these mobile homes is easily worth 10 grand a piece in the condition they're in, like, because they were newer homes. They just hadn't be vacated. Long story on that one. But I could at least fire sell all these, get my money back. Like if this completely tanks, I can at least fire sell every one of these homes, get my money back, and still have a 3-acre piece of land, and I'll come out on top, right? That's worst case scenario. And that's what got me over the first hump. And then I realized very quickly, I'm like, damn, I wish I would have bought those other 3 properties over the past year. I'm buying more. And that's what started it all. And that was 2012 when I bought the first one, but was really introduced to the space in 2011.
Wow. Wow. Yeah. Something you said there, and I was talking about this. I do a Q&A with my Facebook group every Friday. And I forget what the question was that someone had, but I went through this when I was getting in and buying my first deal. It's like the one little thing, and you're like, oh, I love this deal. And then you find out this little thing, and you're like, no, I don't think I want to do the deal now. Right. And I backed out and kind of pulled out of a lot of deals that I should have bought in the beginning because of, I was scared. I mean, the bottom line was that I was scared to lose. And I think
Yeah.
everyone goes through that a little bit until they get comfortable with the asset and you know what you're doing to a certain degree.
It's good. It's good to have fear, right? I mean, it puts things in perspective. So, I mean, I think to have fear and then just quit altogether is different, right? But to have fear and then persevere and try to get the answers to where that fear is coming from and try to get answers to those questions, right? And get comfortability around it. I think those are why you and I are still here buying today, right? And we found success within the industry. So
Yeah, yeah. And here's a question for you. Like, you've done a ton of deals, and I know someone looking on the outside would be like, oh, there's nothing, Kevin Bupp doesn't get fearful of anything. What gives you fear today, or what has given you fear recently?
Hmm. You know, respective of the industry, is
Yeah,
that?
sure, sure, a
Yeah.
deal or whatever.
Yeah, I don't know if I don't know if it's fear per se, but I will say that, you know, one thing that I'm probably much more conscious of, and I we don't steer away from it. It's just I'm realistic of how much bandwidth it takes within the organization is major turnarounds and heavy lifts, and we've done
Mm,
a ton of them. Right, like that was pretty much what our business was for many years, and so I am I tread very lightly when we're looking at a deal that's got such a heavy lift, because I want to look at across the entire of the organization, how drained is it going to be to
mm,
the entirety of the team, and how many resources are we going to have to throw at this property. And then there's always the unknowns, right? When those heavy, every property, even the nicest ones, have the unknowns, right? They've got skeletons in the closet. The big major turnarounds have more skeletons, right? And so
yeah.
um and it's just, you know, you always want to try to keep a positive spirit within the organization. You always want to be, you know, making forward progress. In those big turnarounds, it's sometimes it's tough, man, to keep everyone in a
Mm,
positive light, because this things get thrown at you left and right. And so um i've i've um I've probably have steered clear. We've done less and less major turnarounds over the last probably 4 or 5 years for that reason, and I've found that we have found probably equal success, and I believe lower risk in buying higher quality properties,
mm,
that are going to, you know, trade at lower cap rates, which one might just suspect it's going to be ultimately that means lower returns in general, but ultimately a higher quality tenant base, which means lower turnover of the residents, yada yada. Right, a higher exit price if you're going to sell it, because it might be going to an institution versus that of a small time investor. And
mm,
so, um, again, not fear per se, but it's just we've really switched our model a little bit, where we still do a couple turnarounds a year, decent sized turnarounds, but most of what we do is light value add, where we
yeah.
can pull a couple levers, right? Like rents is one of them, but, you know, infill, like,
Mm,
you know, if it's you know, normally we'll buy something that's infill that still would qualify for agency today. So it might have like 20% vacant lots, right? But still we can get agency on today and know that we can get a supplemental thereafter, after we, you know, bring in the remaining spaces. So we want things like that to have a very clear path. They'll have some variables along the way, but you know, far from maybe buying a 200 space property, you know, it's got only, you know, 30 occupied lots, we're going to do major infill, or it's, you know, 150, you know, 200 space property, 150 occupied lots, but 30 of them are vacant, old 1960s and 70s homes. And then it's got a batch of 50 park owned homes that are old and worn out and beat up. And then some tenant owned homes, which you question how many are going to actually stick around, or were they just given the homes, you know, did the old owner just give them to do it for free, which you and I know how that both turns out. You end
yeah.
up back with those as well. Like there's a lot of variables in those types of deals, and you can make a lot of money if you buy it right. But over the years, those things started trading for ridiculous prices. There wasn't enough of a delta between, you know, the risk associated with a major turnaround, the one I just, you know, gave an example of, to that of a much more stable, higher
Mm,
end quality property. I feel like that delta shrunk a lot. It did the same thing in the multifamily space. That's why a lot of guys that were buying the C class multifamily, you found, you know, before rates started going up, they started moving more to like B plus or A minus, like higher, newer built types of properties, because the, you know, the delta of where those things were trading was basically closing. It was practically the same. And so it's like, okay, well, why am I going to take, you know, equal amount of risk on a 40-year-old property, you know, with a less desirable tenant base than I would on a class that's 6 years old, and it's got, you know, white collar tenants that live there, and are probably going to have a better collection rate. And so, again, not a fear thing per se, but like that's just, it's a big shift in how we look at opportunities nowadays, and maybe what historically our business has been like.
yeah, yeah, for sure. And I mean, you know, I was going to ask you, like, make a comment and then ask you because, you know, we've bought a few stabilized deals here and there, and we just bought one back in July. It was a nice deal in Leesburg. It was a 55 and
Mhm.
over community, which we don't really
Nice.
get into that market typically, but we got it for cheap. We got it through a mailer from a mom and pop. It was a great deal.
Hmm.
But I got to tell you, like the operational headache with that one is like there's like nothing, and it's pretty enticing. I'm like, man, how can we buy more of these? Because it just sits there, and there's really nothing involved in it. And so, like, I see your point, and we've been going back and forth on some of that because with some of the heavier value add stuff getting more expensive to buy, and the value jump isn't as there as quickly, I can see where you would transition into doing more stabilized stuff. Like, when
Uh,
did you make that
yeah.
transition?
And we're not, and it's not a full transition because I mean it's funny because we're doing a pretty heavy lift right now, roughly a 200 space community. We got it ended up getting down to about 50 or about 48 occupied lots, and long story. We don't need to go through it, but the reason why it's fully developed, it was fully occupied, 15 years ago. Now it's not. Great market though. Just long story about the past ownership, two ownership groups. And so we're bringing like 120 homes in over the next like 3 years. So, but like that one, you know, we can do that. That thing's not going to throw off obviously any cash flow. I mean, it's going to be a cash suck for the next 3 years until we can either recap it or if we decide to exit out, whatever our plan is. I mean, our intent to recap it and keep it, but you never know. But that's a cash drag. However, we have a number of other properties in the fund that are much more stable properties, right? And so we can blend it and still do really, really
Mm,
well, keep constant distributions to our investors by blending stable assets with a turnaround here or there. But if we did three of those, only one stable property, then it's not going to make a difference. It's going to be those three are going to do a cash drag that literally doesn't allow you to make distributions, or it's just it's a completely different type of strategy than what we're looking at today. And so again, we haven't completely gotten away from it, but what we're looking for is like our investor base. If you had to put them in buckets, right? You got like three buckets. How I like to categorize, LPs or investors. You got the bucket over here that's they make good money, right? They meet the accredited investor status, but they're in early stages, right? They need to create momentum with their capital. They need to recycle it. They're still very much in beginning stages of their wealth building journey, and so they need their money churned on a regular basis, right? They're willing to take higher risk because they want higher returns. It needs to churn on a regular basis. And you got like the middle of the road, like they've made really good money, don't need to hit home runs anymore, need a little bit less risk. But they still want to hit doubles, right? Maybe hit a triple here and there. So the risk level somewhere in the middle. But they're still kind of like the 3 to 5 year guys, even, right? Like they
mm,
still need to recycle that capital, but they'll do it in maybe deals that don't have a high of a multiple, or just aren't as much risky as like the big turnaround I just gave you a mention of. But they got this third bucket. They're the wealth preservation guys or gals. They've made their money. They want to. They just number one. They don't want to have to think about it. They just want their mailbox money. They don't want to have to think about getting you selling the assets every 3 or 4 years, and that's great. You give them a big capital gain, but now they've got another problem. They got a tax problem, and they got to find another home for that money, right? Like they're all spending their time on their boat or whatever they're doing, right? Like they don't want it. They just want, don't lose my money. Give me a good, solid, steady return on it in a really high quality asset in a good market that's not going to go anywhere. But don't cause me problems every 3 or 4 years when you go to sell these properties. I got to deal with the recapture and the gains and then find another home for the money. Just put it in good assets and give me just a moderate return, and I'm happy. Like that's really where we've honed in our business. And so we're trying to build our business around the investor base that we work with. And then on top of that, it allows us to really have a longer term vision of these assets of,
mm.
we know they're not making more. Like we buy parking and we buy mobile home parks. Neither one of those asset classes they're literally not making more of. It's the two that have a diminishing supply. And so when we find them in great locations and great markets, we don't want to have to be forced to sell every three
Yeah,
to 5 years, right? Because every time you sell, it inherently becomes more difficult to find a replacement property, right?
yeah,
Especially at a good price, at a good basis. So um, I would say over the last 3 or 4 years, we've really been making that switch in a big way. And really, the last 2 years,
mm,
that is our model today. That's what we're doing. That's the direction we're rowing. Everything we buy now, we look through the lens of keeping it for 10 plus years. Not saying that we will. I'm sure there's going to be some assets that we tend to pluck out over time. But we have the longer term horizon. Our investors are aligned with that long term horizon. So it allows us to buy higher quality assets, things that will stand the test of time, better infrastructure, even like the big
yeah,
turnarounds. Another thing with those, like you get these ones that were, there weren't zoning regulations and ordinances, 40, 50 years ago in a lot of these markets where these parks were built. So you find a lot that were built right. Like you could tell they had a civil engineer come in, design the property. They they laid the infrastructure deep enough in the ground below the frost line. They did it right. But then you got these other ones that are just a bag of unknowns, right?
yeah,
And there's just lots of hair on them. And you might be able to make money by turning it around, bringing homes in, doing the necessary fixes, but you know that there's not really a lot of permanent fixes for some of the issues that it has, right? You just kind of, you do your best and then you sell it and you move on to the next one, right? So we're trying to find the ones that were built right, can stand the test of
Mm.
time, that we can truly comfortably hold on to for, 10, 15, 20 years. Because again, they're not building more of them. So again, it's an interesting space, and it's been interesting to watch it evolve over the last, 10 plus years. And, I look back again, I wish I would have bought everything now. It's funny, like, in hindsight, but I wish there's so many deals I wish we'd have just bought, because we would have done incredibly well. I didn't realize it was going to get consolidated this fast. I knew it was happening, but I didn't realize that it was going to happen as fast as it's happening. So,
Yeah. Yeah. And do you think that, I always have this question and thought, like, do you think we'll be saying, because some of the prices on stuff that I look at, especially here in Florida, I'm like, God, like, ugh, that's hard for me to make
I
sense
know.
of. But I'm like, it's going to be harder to buy that next year. It's going to be harder to buy that the year after that, I would think. I mean, do you think that, in 2030, we're going to look back and say, damn, the 2025, we actually should have taken down these deals that we passed on?
Yeah, I mean, I do think they'll continue going up in value, especially when you start talking about like Florida. If you're like in Orlando MSA or Tampa MSA or Miami, or Jacksonville is probably the lowest of all those tiers of the major four markets in Florida. But Orlando, Tampa, Miami, I mean, they're all, Florida in general. Even the tertiary markets in Florida outside of those major markets are great. I mean, they just
Yeah.
are.
Yeah.
I don't see prices coming down on these assets over the years. And I think if your capital stack, your capital source allows you, so it's not a function of like, should we buy these? It's like, okay, can you buy them in a price, even though you might not be stealing them, you might not be buying them for below a market value, you might be paying full retail, but does your capital source allow you to, can you still
Mm.
buy them and comfortably get the returns to your, I think that's the biggest challenge, right? We don't own anything in Florida right now outside of a few personal properties that I own, because for the quality that we want, we don't have our cost of capital is much greater than that of a lot of the big players that are buying, gobbling up big communities in the Florida market. And so while
Yeah.
we'd like to buy them, and actually we make run at it, we make multiple runs at them over the years to buy some of these nicer assets, but our cost of capital prohibits us from, even if we wanted to buy it, we wouldn't. Like we'd be upside down. It'd be a losing endeavor. We wouldn't be
Yeah.
able to hold it because of our capital structure. So
Yeah. Yeah. And that's the same boat I'm in when I look at these deals. It's like, okay, this wouldn't make sense for our particular capital structure, because for the
yeah,
exact same reasons that
which
you
pay
said.
because I want them,
I know. I
and I'd
know.
like to pay you what you want for it, but I can't. It's not that I don't want to. I truly can't pay you per lot what probably someone else is willing to pay you for it. That's the problem.
Yeah. Yeah.
If we
Yeah.
could,
There's
we
the,
would. To answer your question, if we could, we would. We really would. I would own a lot more in Florida. I think the one big risk though in Florida, is as you get near the coast. I think that's the one thing we've always kind of had challenges with, when you're near the coast is, smaller groups like ours. If you have a detrimental, or catastrophic event, a hurricane, just like we had multiple now over the last 2 years here on the coast, and it wipes out your community. You got business interruption insurance, but they only sticks around for so long.
yeah.
You got a lot of risk associated with being able to rebuild. You got the cost of rebuilding, and like a lot of the big companies might self-insure, right? They've got different structures in place to manage that risk. But if you're a smaller outfit and you own, a couple expensive properties on the coastal areas of Florida and they get wiped out, like how does that impact the rest of your business, right? That's definitely a risk that we take into account anytime we look at anything in Florida. And honestly, it doesn't even matter if it's in Central Florida anymore, because I feel like most of these hurricanes, they end up tearing across the middle of the state and doing equal amounts of damage in the middle of the state than they do on the coast. So you guys just don't get the flooding like we do on the coastline.
Yeah. Yeah. We were looking at a deal in Safety Harbor, which is, I'm
Mm-hmm.
sure you know where that is, down by
Yep.
Clearwater. And, just couldn't get comfortable with it because it was right there on the water. Because I've got a lot of stuff in Florida, but I like it inland. I
Yeah.
like it inland where I can at least control the trees. We put the tie downs on the homes, the like
Mm-hmm.
hurricane tie down, so they can't get blown over. So I think we can mitigate a lot of the risk to a degree. But
Yeah.
people have heard me talk about on the show before. I would be totally lying to you if I told you that, like, I wasn't checking the last storm as it was going through Lakeland, like every second, like how fast are the freaking winds right now? How fast are they? But we ended up coming out okay, but it's definitely a concern, and that's why
Yeah.
we're looking at expanding in other areas too.
Well, any area you own, it's got its own, share of natural disasters that can occur. I mean, honestly, like Hurricane Milton that went up through the Gulf. We own some parks in Georgia. One specifically is in Valdosta, which is
Mm.
right off of Interstate 75. Just right over the border of Florida and Georgia, about an hour over the border. And that Hurricane Milton went inland and literally went right over our park. I mean, we lost some trees and uprooted some septics and stuff like that. Lost one home that just happened to be one of the vacant homes anyway, so it wasn't that big of a deal. But so it could happen anywhere. I mean, I don't know how shielded you really are. And then a year and a half ago, we bought a park outside of Columbus. And literally, I was literally out with my family skiing, and it was in March, February, March, and this freak winter storm, you know, spun off a tornado, and literally completely demolished not our park, but a park like 4 miles away. It was like
Oh,
a
shit.
250 space park, completely wiped it out. And this is in Ohio, in the middle of winter. This freakish storm again.
Wow.
It was like an F3. I mean, like it was like a real tornado that you do not expect to see. You see in the Midwest, but not like Columbus, Ohio, Midwest, right?
In the
Um,
winter.
in the winter, yeah, it wasn't like a summer afternoon storm or anything. But it literally
Wow.
the night before closing, that storm went through and completely annihilated a neighboring park. So again, there's risk associated with any business, any industry. We have business interruption insurance, as I'm sure you do.
Yeah.
We're typically on we have our parks listed with FEMA as kind of a backup, because the good thing about mobile home parks and RV parks is that when a natural disaster occurs and you need temporary housing, typically the parks are back up and running fairly quickly for FEMA units and what have you. So I think there's a good plan B in the event that something like that does occur. So
Yeah, yeah, and of course you hate to even for that happen, but there's at least some options. But
yeah.
um, I was going to ask you, what's the biggest mistake you've made in mobile home parks that's like cost you, I don't know, seven figures or more?
Yeah, that's
Any?
um yeah, I mean, I don't know if we've had any like deals that went sideways or that we lost money on like that cost us money, but I think the best way I could probably answer that is we've really keyed in over the last probably 3 or 4 years on hiring and really building out the company of what we want it to look like in 5 and 10 years, like who's going to have to be here in the organizational chart, like really strategically planning. And then it's making those difficult hires, expensive hires before you really need them, and kind of working
Mm,
into them because it's expensive. But what you find is that when you start bringing people that are way smarter than you within your organization, and you sacrifice to do that, probably because most people, I was always reactive with hiring. I think most of us are just by human nature, like we wait until the point in time where we're like, oh my god, like I'm running rampant, I need help in this area or that area, whatever it is, right? And then you hire somebody, and then it's chaotic, bring them on board, and it's stressful for them, it's stressful for you. The onboarding process isn't that great. You might not even hire the best talent because you're kind of in a precarious state. You need someone today,
yep.
whereas forward looking, making strategic hires, taking the time, and when you find someone, you're like, what I wasn't not necessarily ready for this person. I don't know if we really have the budget for him, but like this, he is it or she is it. Like she is a perfect fit of our organization. She's got the right core values. She's in alignment with what who we are, what we want, and know that he or her skill set or expertise will help us get to the next level. I
Mm,
wish I'd have started thinking like that much earlier on, because the growth that we've had over the last couple of years has been incredible, and I can only attribute that to the team. It's not me. It's
mm,
not my partner Brian. The only part that we've had, the only aspect that we've had involvement in is like, just forward looking, making those strategic hires, finding the right folks that can help, carry the business way further along than what we'd be able to take it by ourselves, and really sit in that, the executive roles, CFO. Really, we're bringing someone in right now that's really we're trying to mold to where can probably step in one of our shoes at
mm,
some point in the next couple of years as well. But really thinking strategically of what's it need to look like in 5 years to 10 years to reach our goals. Who needs to be in those seats? And ultimately, we want to find ourselves. I'd like to find myself. I'm 45 now. My youngest will be going off to college when I'm 55, and I'll never want to be out of the business. But I would like to build the business to the point in the next 10 years that, again, all about buying back time and buying back flexibility. I don't know where my kids will end up in the country or the world, where they go off to school or whatever they decide to do. Maybe they end up wanting to join the business. I'm not sure, but I want to have flexibility with my wife and I to be able to go spend time with them. And the only way that you can do that is putting the infrastructure in place for the company and doing it ahead of time and not being reactive. So again, don't not necessarily probably the exact answer you're looking for, but I would say if we'd have thought about that earlier, we'd have made a lot more money in the earlier years if we'd have been more strategic with hiring.
Yeah,
It's tough
yeah,
though when you're starting a business, because like right when you like, it takes you a while to start making money yourself. You're like, oh my god, I'm finally, like, I've been slaving away, working 80 hours. Now I'm finally making just enough to like start paying myself a little bit. But then you're like, I'm out of time and I really need to hire an executive assistant or whoever that first hire is. Right. And you're like, damn, I'm just only paying myself like 50 grand a year, but now I got to go hire this person that's going to cost me 50 grand a year. And I got to go back. I got to take 2 steps back to
yeah,
take some steps forward. Right. And that's tough. It's really tough.
for
But
sure.
I will say that in the long run, um, if you can have some delayed gratification and just really sit down and plan out what your organizational chart or whatever you want to call it looks like to get to where you want to be in that 1, 3, and 5 year mark, and just be willing to have that delayed gratification just a little bit longer if you can, right? Instead of just taking that little bit of money, start making some hires proactively.
Yeah, and you're right. It's tough because like if you're in the real estate business, it's a delayed gratification
Yeah.
business
Already.
anyways.
Yep.
And as an entrepreneur, it's exactly what you said. I know every entrepreneur goes through that because I go through it. I'm like, I don't want to hire this person, blah, 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 him and haw about it. And it ends up being the right decision. Usually the ones that are, more difficult for me to make the decision and hiring, like, hey, let's just go for it. Those are always the best hires
Yep.
in my experience. What have been some of the key hires that you would say that, like, man, this was a great hire, not necessarily a person, but a position? Like, what were you getting off of your plate?
Yeah, that's a great question. Controller was a big one. We
Mm,
just formally brought in a CFO about a year and a half ago. That was huge. Someone that had helped grow a couple funds to $1 billion+. Um, really really well tuned into the syndication world, and anyway, so just lots of background expertise and groups just like ours that started
mm,
from small to want to grow to big. So that was a big one. The funny thing is that my business partner, he's had an executive assistant. So like, I'm kind of a hypocrite when I say like, be proactive with hiring, because my business partner, he's had executive assistant probably for 3 years now, and she's awesome. I mean, she literally is amazing. She keeps his life in check and that side of the business in check. Like I'm not going to say that we would fall apart without her, but she's amazing. I watched like the
mm,
magic that happens over there, but I knew it took him a little bit to find her, right? And took time to train her and all that. And so for years, he's been saying, Kevin, you need to get an assistant, man. I'm like, but to your point, it's a lot of work to hire somebody, especially when you
for
start,
sure.
especially when it's like, hey, this guy or gal is going to be in my email. There's a personal level there as well now that has to
Yeah,
come into the fray. And I'm like, I just don't know if I want to commit the time to do it. I do know I need it. You're right. But like, that seems even like a lot more work to do this. And I finally brought that person on board about 7 or 8 months ago. And here's the thing. Don't get me wrong. Like the first month's a little bumpy, but
sure. Yeah.
he is so smart and so forward thinking and so incredibly organized. I mean, like, that's it. Like, bring the right talent in. Like, I don't have to train him that much. Like, honestly, like, it's just
Mm,
he just spends time with me and he figures it out because he's really smart. Like, his cognitive level is like off the charts, right? So like, we make all of our hires go through. We make them take a predictive index test, make them take a cognitive test to make
mm,
sure that, again, it's hard. Emotions get into the interview process, but if you use some data along with it and
yeah.
just based it on science, helps you make better hiring decisions. But anyway, I brought him on board and like, again, month maybe trying to learn each other, figure each other out. But like now he sees where I have weak spots. I don't have to tell him. He sees where I have weak spots and just steps in and figures it out. He's made my life a hell of a lot better. So
Yeah, and those are the hires I like because me, like, so we have people take a personality test and like an IQ test and things an aptitude test when they come in,
yep.
and I'm just really bad at training because I'm like, hey, figure it out. Like, you
Yeah.
should know this already. And so it's always bumpy when I bring someone, especially like from an executive assistant level. And so I know what you mean. And it's like, oh, I don't want to have to do this, but it's a lifesaver after it, because you don't, like, Kevin, you don't need to be playing around with your calendar and figuring out when you're going to schedule stuff or all this other little stuff. And it's like, it just saves you a lot of time, and it's worth it a
Yep.
lot
Yeah.
in the
Yeah.
end.
No, absolutely. And then I'd say one other critical hire that we made. It's been a couple years now, but it's more on the property management side, so the operations side of the house. And we have like a director of operations, and we got a couple regionals out in the field. We brought in a dedicated construction manager. So
Mm, big,
historically it was kind of rely upon, well, even before we had like regional vice presidents like in different regions, like it was rely upon the community manager, right? To help find local talent, to manage rehabs, take pictures, all that. Like that is quite the process.
for
But
sure.
we hired a construction manager to not just with the rehabs in terms of homes, but capex projects on an annual basis. So he oversees all of that, handles all the
Mm,
bids, leverages the community managers and RVPs and all that to have them help, right? Because they're visiting the communities all the time as well, and he can't get everywhere all the time. So that was a critical hire. And then I'd say one of the big change that we made, and this happened like 7 years ago, but it was huge, is we used to rely upon our community managers to do all the advertise, like they would post the ads on Facebook or MH Village or Craigslist back then. And then, they would be the ones that would be, manning the calls, responding to inquiries, handling, the application process, everything like kind of soup to nuts. And, the director of property management would be overseeing that per se, but it's really difficult to manage the accountability of all the CMs. There's some better technology now that allows you to do it. But just, are you posting the ads? Are you renewing the ads? Like all that stuff. And, while they're incentivized to sell homes and to lease homes, it's really difficult to find someone that's also a really good salesperson as well as a really good community manager. Like it's two
yeah.
different talents. And so we centralized the sales and leasing aspect of our business. So it started as one person, but that person's incentivized to not only post all the ads for every community all the time, keep them renewed. They coordinate with the community manager when someone comes to see a unit, but they handle all the applications via DocuSign. They handle all the credit pulls, all the background checks. But then also for showings, they're incentivized to follow up after we do a showing to find out how the experience was, find out how the home looks, how does it smell, like anything you'd like to share with us, right? Because it's pictures only tell part of the story, right? Community manager will
Yeah.
take a picture. The unit's ready, looks good,
Yeah.
showable, but then you hear, now we're doing follow-ups with people that are going to look at units. Well, why didn't it lease? Why didn't they file an application? Well, now we know why, because it smelled like whatever, mold or mildew, or there
Mm,
was dead bugs in the floor or whatever, which you didn't see in the pictures, right? So centralizing that part of our business has been huge as well. It just gives us a
mm,
lot more control and leverage in knowing that the job's getting done, and it's getting done on a regular basis. And a team now is being incentivized to do it outside of the community managers.
yeah. Yeah. That's, yeah, I can see that. We've centralized a lot of stuff that we used to leave on community managers, and it does make it's at least made it easier for us, especially from
Yeah.
a home sales perspective and things, because um, these community managers sometimes, you know, and especially if they're dealing with contractors and stuff, like you said, you never know. We've had some that have made side deals and we're
Oh
making
yeah.
some money off the top of.
Absolutely. Well, I mean, yeah, I think it's just you give a little bit of rope, and like in those situations, like you're giving a lot of rope, right? I mean, it's just you're kind of setting yourself up for failure. You're going to have some really good, honest people. Most people are honest, right? Most people are good
Yeah,
people, but like it's you'll get plenty that necessarily aren't, and give them the opportunity, like they're going to take advantage of it. So we just found it was less brain damage for us to centralize that, and just instead of having that, have you renewed your ads, like, well, why are your numbers down this week? Well, I have to go back and dig. Oh, I know why, because you haven't posted any new ads in the last 3 days. Like just
yeah,
that whole process, it's so much easier to go to one person now. We have the data for it. We know when ads are being posted. We know what type of traction we're getting and how many applications we're getting out of those applications, how many people are getting approved. Like it's really simple, and only one department's responsible for that, and it's separated from the CMs. um,
yeah.
so yeah, it's
Okay.
it's
Yeah, I like that. Um, so on from you guys, like on the capital side, are you
Mhm.
guys just all retail investors,
We
or
are. Yep.
yeah? And you
We
built
are.
that up over time.
We built that up over time, and it's taken a lot of time to do it. And we've gone down the exploratory path of different types of, whether it be a family office or different types of institutional partners, and just I struggle. It's nice to know that you can go to one person and get a check. But I also like being an entrepreneur and the owner of my business and get to make our own decisions and not necessarily, have to report to another entity that's providing the capital, or be at their beck and call. So I like, that's the part I've always struggled with. And it's interesting because I have a lot of friends that are in the institutional world, so I get to see it through their lenses. And it's funny because we always think the grass is a little greener because it's just easier to capital, right? You got bigger capital sources, but then they have the same envy for what we do on our side with the retail capital. They're like, oh my gosh, the fact that you guys literally just you got a little bit of autonomy. You don't have to have meetings 3 times a week with your capital source. You've never had an issue where you got a great deal, and now the capital source that's brought money to the table 3 times, all of a sudden they decide at the last minute that they don't want to do the deal, and your money's already hard. Like, just all these like crazy situations that have occurred that they've seen in their world that doesn't necessarily happen on our side of it. So, but we have to deal with hundreds of investors, and they're dealing with one. So,
Yeah, yeah.
pros and cons.
Definitely pros and cons, and we've looked at going down that road. And I actually had a conversation the last 2 days with two groups, and it's like, I'm an entrepreneur. I'm a rebel at heart, and like, having the investors to answer to and stuff is like enough for me. And having one institutional partner that wants to pick apart everything, and like, you're subservient to them. It's just, I don't know. It's not that exciting to me. I think I
Yeah.
think we're on the same page there.
Yeah, yeah. I mean, the conversation we've had internally is, if I was, is if we can continue doing what we're doing, hitting our growth targets, what we want to do as an organization, and we can do that with the platform that we've created, to where we can bring in the necessary capital as it's needed, then why would we look elsewhere? And so that's kind of what we've gone through. We've had this dialogue for years and years now. We revisit it every year, and always come up with the same end result. Is like, why would we change it? Like, that part of our business is not broken. It's
Yeah.
and why try to repair something that isn't broken and go off into the unknown? It just
Yeah.
doesn't make sense.
Right. Right. And where are you guys, like, I know you're probably constantly building your investor list. Is that from referrals, or you guys, I know you're doing a lot of stuff online. Where
I'd
do
say
they come from?
probably now is probably I'd say probably about 30 or 40% is actually from referrals.
Mm,
Yeah, so it's gotten pretty deep. I'd say over the last couple of years, it's gone a lot deeper than
mm,
wide. And yeah, we have done a lot of last like year and a half, 2 years. We've done quite a bit of online. Really, last year and a half, lots more online marketing to bring new investors into the fray. But that life cycle is quite a bit longer. We have found it's definitely valuable to do it, but it takes quite a bit of time. Like, it's a cold lead, right? I mean, it's a cold prospect, someone that doesn't know who we are. They have listened to the podcast. They don't know anything about us. And so the majority of our capital is from legacy investors and or their friends, colleagues, family members, kind of deep into their immediate network.
yeah. Yeah. And we've started running some ads too. And like, yeah, I don't know how people do it that do retail investors that don't have a podcast or an online presence or anything. I feel like, you have that obviously, and I've been doing that. It takes, it may take this long, but now it may take, us, someone to invest that long, because they can get on and kind of see how you are and listen to your
Yep.
show. It definitely makes it easier.
Yeah, no, I agree. I agree. I didn't start either one of my podcasts for that reason, but ultimately what we found is that, um, what we've found is that a lot of investors have, even if they didn't find out about us, maybe they didn't find out about us through the Mobile Home Park podcast. They listened to me on either another podcast, or maybe it was my Real Estate Investor for Cash Flow podcast. But what we have found is that when surveyed, a lot of them went back and listened to many episodes of the Mobile Home Park podcast. To we'd share case studies of what's working, what's not working, changes we're making in the business, just like literally just talk shop,
Yeah,
what's happening on the day to day, and they get a really firm understanding of not just the business, but also, do you know the business, right? Like,
exactly.
are you a proficient operator, and should I feel safe putting my money with you?
Yeah. Yeah. Yeah, for sure. So what do you think? So I always like to talk about a little future outlook. Like, do you see
Mhm.
any like upcoming innovations or market disruptions that could disrupt the mobile home park space in the next 5 or 10 years?
Yeah, that's a great question. I don't really follow the 3D printing stuff at all, so I don't know enough to talk about it. But I mean, I think there could be something there. Again, I'm not qualified to talk about it. I don't know how far along we are with that technology, or is it a matter of 2 years? Like we can print homes for a fraction of the price that they're being made at now in the factory. I'm not sure, but um, uh, I don't. I'd ask you the same question because I don't know. I just think we're in such a unique niche. I don't think there's any risk associated with like, a cheaper form of housing, even if they were 3D printed. I don't know if it'd be a cheaper form of housing to where there's a risk associated with that of, less customers in our industry that need a affordable place to live. I mean, what are your thoughts? I don't think I have an answer there. I don't foresee anything that could be a disruptive outside of regulatory changes. I think are always, top of mind, depending what state you're operating in, depending, who's in the office, who's our administration at that point in time. I do think that's always an ongoing risk.
For
We
sure.
just we tend to stay out of the blue states. We own some stuff in Maryland. I think that's the only blue state we operate in right now. And we've owned it for a long time, and we're actually in the red part of Maryland, so it's pretty landlord friendly. But um, that for me is probably always top of mind. Like that is the if I think that is the biggest risk that exists in our space, is some type of rent control, some type of restriction that ultimately will have a detrimental impact on your business. And we lived it in New York. We owned in New York. Um, and rent control got passed. I think it got passed in 18 or 19. Statewide rent control. It is still the most restrictive rent control that exists to date, and it's catastrophic. It really is. We ended up selling out because I'm like we couldn't finalize our business plan on any of those properties. They restricted it
Mm,
to 3% a year. Um, doesn't allow for you to keep up with with inflationary costs of taxes, insurance, let alone setting aside reserves for future capex projects, capital improvements.
yeah.
I mean, it's just I think that's a big risk. So being weary of that if you're in blue states or just generally speaking, because I think the risk might exist in red states even, right? Like you just don't know. Like depending who gets in office after Trump, right? Like what ultimately what type of policies are they trying to push?
Yeah, yeah. I mean, it always scares me that for that reason that like, hey, some national rent control gets passed, and then our properties that we thought were worth, a 6 cap or a 5 cap are now a 7 or an 8, right? Because you can't. It's 3% a year. That's tough, but that's the biggest concern I have as far as like 3D printing and stuff. Like, I don't know. I mean, there's those container homes. I know you've seen those homes you can get off of Amazon, but they're so small. Like they're tiny.
Yeah, they're tiny. They're not. They're not. I mean, they're not made nearly to the same quality. Probably wouldn't have the same durability as maybe I'm wrong, but I haven't bought one to see. I mean, but the fact that they're flat packed, I would find it difficult to believe they would stand the test of time. And surely you're not going to put it in a place like Florida, right? With wind ratings and all that kind of stuff. So, but yeah, and yeah, what are they? 200 square feet. So like when you really look at it from a price per foot, are they much cheaper? You know what I mean? I don't know what
Yeah.
those things cost, but I mean, they're like 30 grand, aren't they? 20, 30 grand. I mean,
Yeah. Yeah. 20, 30 grand for sure.
I mean,
Yeah.
you can get a brand new, weekend, with the dealer's license, you can get a brand new 3.2 for, $55 a foot,
Yeah.
$60 a foot. So, I don't think that that's a risk. The 3D printing, I just don't know enough about it. Sounds like you've done some research. I'm not sure exactly what, in a couple of years, what they might be able to print homes for, like what price per foot, in comparison to, what current factory built homes go for. But, that could be a risk. I'm just not sure.
Yeah. I mean, I've looked at it a little bit, not too extensively, but it doesn't seem like it's there yet. Like it's still quite expensive to do, but it is something that's interesting that I think the technology could obviously expand.
Hmm.
And 5 or 10 years down the road, who knows? But then again, how many of them can they build and how fast can they build them? I still think that we're going to be, one of the cheapest places in town. How much is multifamily rent going to be in 10 years? $5,000. Like, who knows what it's going to be, right? We're still going to be, I think our asset class is good. And I think regulatory
Yeah.
concerns are the biggest.
Yeah. I mean, if anything, I could see where 3D printing might actually find its home in the manufactured housing space, right? Like with factory built homes, like to where it just becomes a part of maybe that process, right? There's some variations where the 3D printing is actually utilized in some of the production process. I don't know. Again, I don't really follow that space, but I could maybe see where it could become a benefit for us, let alone a risk. In the long run. So again, I just don't know enough, don't follow it enough. I think we're in a pretty safe space right now. I would say where
Yeah.
we fall on the stack of housing. I always like to make the argument: you can go anywhere in the country where you own a mobile home park, where you own a mobile home park, and I can promise you that if whatever park you're going to use as the example, go find a comparable quality um, apartment complex, right? And I guarantee that you're going to get a bigger living unit in my park. You're going to have a little bit of yard, you're going to have a parking space, and it's probably going to be 25%. Your all in costs are probably going to be 25%, 25% less than that of the comparable apartment building that ultimately has got a neighbor above, below, to either side. You got shared walls. And so I think the cost factor, the sales pitch of why mobile home parks are so great, and they truly they offer the most affordable housing option in any respective market, but it's not the lowest quality house. Just because it's the cheapest, it's not the lowest quality. In fact, most times it's actually nicer than that apartment that you're going to use to compare it to. These things are pretty sweet. The ones that are coming off the assembly line now, I mean, they're built with the same materials
They're
that
nice.
stick-built homes are built with. I mean, like it
Yeah.
literally, it's the same. It's not what, if you haven't been in a new mobile home lately, anyone that's listening, I mean, go do yourself a favor and go walk through one at the local Clayton dealership or a local factory, or go to a home show. They're incredible. Even the base model ones, right? I mean,
Yeah.
they're incredible. And you can get, the thing is, there's different quality. You can get the low base model, you can get the medium grade, or there's some really, really high end ones as well. Full drywall, LED recessed lighting, quartz countertops, um, luxury vinyl plank flooring. I mean, like they're same materials that are used in the home that you're probably living in today.
Yeah. Yeah. Totally. Like some of the new double wides that I've seen and been in, I'm like, damn, like this is nice. This is really, really nice.
Yeah, absolutely.
Yeah. Okay. Final question here. It's a deep one. It's a deep
Uh-oh.
one. At the end of your career, Kevin, when people talk about you, when people talk about Kevin Bupp, what do you want them to say?
Ah, good old like eulogy, huh?
Yeah.
Um, yeah. Yeah, it's a great question. I mean, I'd like to think that people would say that I was a good listener, someone that was always willing to lend a hand, help out, that I was kind, thoughtful. Hopefully, that was a good boss, good to work for. Family first always, right? Like we're with all of our employees as well. Like it's always family first. Do what you need to do. Your family always comes first. Um, Really, I think just simply put, I left the world hopefully in a slightly better place than
Mm,
when I was in it. I mean, I think that's that. To sum it all up, I think that's really it. I'm involved in a lot of different charitable endeavors, and I just try to follow the golden rule, try to instill that same behavior in my kids and just our employees and anyone that's on our team. And again, I just try to make the right decisions, the right choices on a day by day basis, and hope by doing that ultimately, again, leave the world a slightly better place than when I was in it. I think that's the easiest way to sum that all up.
yeah. Yeah. I love that. I mean, I think all entrepreneurs have that, like, that drive to, like, hey, I want to leave the world. I want to do something good in the world. And,
Yeah.
fortunately, we get to do that um, as entrepreneurs. So I think that's awesome. Um, Anything you want to leave the audience with before we go? Any gold nuggets? Like, hey, if I could have learned this one thing about mobile home park investing, I'll leave it to you. Whatever you want to say.
I mean, I think if you haven't bought your first park yet, the great thing is like there's a lot of resources now, good resources like Derek, this podcast, and I know you have a training program as well. I mean, there's a lot of great information out there that didn't really exist, many years back. And so just lean on the resources that are out there. There's plenty of good folks in this industry that are willing to help you out, answer questions, send you down the right path. And so just again, I'm only really speaking to at this point those that haven't bought something yet that probably are listening in, just like you and I did, right? We try to get as much information as we can before we make a decision, and but just you got to pull the trigger, and just know that there's a lot of folks out there rooting for you and cheering for you and willing to help you out because you're going to encounter some challenges, some road bumps, some hurdles along the way, but there's an answer. We've all been through them. So just lean on those that have been down that road already. So just get a deal done. I mean, I'm not going to say there's ever going to be a point in time where the space is fully consolidated. I think there will always be deals, even though they're not making more of them. People will be bad operators. People will run things in the ground, and so there's always going to be things that transact. But I will say that there's still quite a bit of runway. There's
Sure.
still time to get in and get it. You'll buy things at a really good basis and be part of just a phenomenal industry.
Yeah. Awesome. Awesome. Well, Kevin, thank you so much for coming on the MHP show. I know you left our listeners with some gold nuggets here. So again, we'll have to have you on again at some point,
Yeah.
and we will see you all next week. Peace.